something big is going on in the market. Stocks are up, so too is yields, commodities, and the US dollar. So when correlation doesn't make sense, what exactly do we need to turn to? That's what we're here to talk about. In today's video, I'll give you everything you need to navigate what is a crazy week ahead. Not only do we have some earnings reports from market movers, but we also have FOMC, interest rate projections, PPI, CPI, as well as a bunch of other things happening around the world that can definitely bring the volatility. So in data-driven weeks like these, it's best to get back to the basics and avoid all the noise. So that's what we're going to do. So we're going to talk about earnings, the labor market, where we stand with each, as well as liquidity. Will stocks go higher or will this be the end? We've got a lot to talk about. Let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Let's get into it. Okay, this is the daily heat map of the S&P 500. Actually a fairly green day across the board. Yeah, there was some red, but you know, the big boys participated and that was really it. Now, the big talk of the town was actually Apple, down 2% here after its very disappointing WWDC conference. Actually a very boring keynote speech as well. I was watching it and no entertainment value. Other than that, tech actually put out a really good day. I mean, AMD was down, but semis were up for the most part. I mean, Microsoft really lifted infrastructure technology and software as a whole, actually putting out a fairly green day, all things considered. Amazon participated, same too with Google, Meta. When these big guys participate, you're really going to see a lot of upbeat action. We saw the worst performing sector here today was probably financials. I mean, except for a couple of subsectors, and I think it was for a couple of reasons. Number one, credit services got hit because of Apple Cash's innovations. PayPal was down 2% at one point. Visa was down 1.3%. MasterCard, American Express. I think a lot of the worry there is overblown. I think a lot of what we saw in banks and insurance actually had to do with what we saw in Europe and the political polarization happening right there. What happened in France, what happened with the EU Parliament. Just because Europe is heavily weighted to banks, that did weigh on bank stocks as a whole. That is actually part of the reason why yields increased, along with, you know, some of the momentum we saw on Friday, and also that banks were the best performing sector on Friday. They were just giving some of their gains back, and that's why financials were one of the worst performing sectors here today. I think a lot of the concern there is overblown and should blow over overnight, because we had a very green day across the board, including here in commodities. Look at stuff like energy, basic materials. I mean, there were winners, there were losers, but fairly upbeat overall, especially here in utilities. What was very weird is that yields actually increased on Friday. Yields actually increased today. Real estate was actually very green on the day. So very weird price action. I don't know why that is. You'd think that real estate would be sold off on a day like this, but we saw some very upbeat action here. So it looks like there's something happening in real estate that I don't really know of. But all in all, guys, a very green day across the board. But let's dive into sector analysis. And if we actually dive in very quickly, we saw the best performing sectors were actually rate sensitive sectors. Look at XLRE, look at home builders, home construction, and commodities. XLU, XLE, right, GDX. They were the best performing sectors. And then we had semis here, but they have momentum behind them. That's why they're up there. So the best performing sectors, rate sensitive sectors, commodity driven sectors. The worst performing sectors here was just financials, you know, down 1.55% here in KRE, regional banks, and down 0.39%. So, you know, pretty rough day across the board here. Now, we did see some commodity driven sectors. Look at materials, XLB, look at metals, XME, they were down ever so slightly. And then we had, like, right above that, we had staples, and then XLC, technology and software actually putting out pretty good days. And I mean, if you remove semiconductors from these tech names, tech actually put out a very average day for the most part. So it seems like a lot of the upbeat action we saw in tech was really based on semiconductors, as well as Apple dragging down the technology space as a whole. But all in all, a fairly upbeat day. The S&P 500 up 0.26%, the Nasdaq up 0.39%, the IWM 0.34%, the RSP up 0.27%, mid-caps up 0.19%. So a very upbeat day across the board. Very green in the context of yields actually rising. Look at the 10-year yield on Friday up 3.4%, today up 0.81%. And we did have a couple of bond auctions that didn't do so well, but they weren't longer term bonds. They were more of the in the bill side of the curve, but they didn't go so well. So yields did increase. Bond auction demand wasn't quite there, but stocks still rallied regardless. So it seems that the market is sort of looking past what yields are doing right now and assuming that we probably are going to go lower right here. and also waiting for the FOMC, the interest rate projections. I think the market is probably expecting a dovish tilt from the conference board. With yields up, we actually saw bonds down. We do know the inverse relationship that occurs right there. And then we also saw commodities get on quite the rally. That's why commodity stocks actually did pretty well today. I mean, look at gold up 0.74%. Look at silver up 2%. And you can see with both these metals right here, silver actually forming support at this key level, having come down. So we're still in a daily downtrend here for silver, but it's looking like it wants to find support at this 28 key level, which we did use as resistance right here. So if we do find support, we can actually move up and continue the 52-week high action. We saw a very similar situation to gold. You can see that this is a very key level right here. If we find support, move higher, this would be an equal low, and then we can actually just move higher, continue to make new all-time highs there in gold. One thing the market also looked past today was actually just a stronger dollar. The DXY was up 0.16% after being up 0.81% there on Friday. So very, very upbeat action. Yes, I do know that we did see a bit of weakness here at the top of the day, but normally speaking, when you have yields up, dollar up, stocks really take it on the chin, and we're actually just not seeing that even here in after hours. Slightly upbeat in after hours. So this correlation is eventually going to break down, and either stocks are going to fall or yields and the dollar are going to come back to earth. One of those two is going to happen. Hopefully stocks stay up and yields just trend a little bit lower. But again, I think the market is just waiting for the FOMC. I think the macro events this week is going to determine what happens to everything: stocks, bonds, commodities, currencies, the whole 9 yards. But let's actually have a look at the S&P 500. Now, again, you look at this and it's pretty bullish. This is a new all-time closing high for the S&P 500, 53.60. And we can actually see that while we are a way bit off the highs here in the advanced decline line, we did actually move up ever so slightly. We also saw fairly upbeat action here in the RSP. Again, quite a bit off the highs, but we did put out a green day of 0.27% in the RSP, along with the S&P 500 putting in an all-time high. So too did the Nasdaq at 19,080. Very positive action in the S&P 500 and the Nasdaq. Now, last week we were looking at this key level right here, the 5250 level. This week the key level is actually just the 5300 level. Why? Because that is the gamma flip zone. The gamma flip zone has actually moved to the 5300 level, and I do believe that if we do have a bit of weakness this week, if we do pull back, let's say stocks come back to earth after what happened with yields today, I think we're going to find support here at the 5300 level, find support right here, and then continue the move upward. I think that's what's going to happen. If we do go lower, below 5,300, I'll give you guys an update as to what happens next. So go ahead, subscribe so you don't miss that. But yeah, 5,300 should offer very, very strong support. It's the gamma flip zone. We just made a new all-time high. And I think the only thing that's going to derail us tomorrow is if we have like some form of a hawkish, dovish tilt, or interest rate projections don't go our way, as well as hot CPI. But I don't think that's going to be the case. I think CPI is going to come in line or cool. And I think the Fed is going to do what they've always done. They're going to continue to assess the data. They're going to leave rates on hold, and they're probably going to come out neutral, which is de facto dovish, and the market is probably going to trend sideways, if not up. But those are just my predictions. I wouldn't take it as God's word. Anything could happen with FOMC. We don't know what data the Fed's going to look at, and we do know there are a couple of hawks on the board as well. But all in all, guys, we want to be buyers of dips here at the 5,300 area. But ultimately, if you weren't long from here, this year or at the start of the year, I don't think you should really be buying at this point right here. What you really should, you should already be in positions, and you should just be holding stock, looking for the 5,400 area. That's the key zone we're looking for into the June OPEX. We're looking for this 5,400 area. So, buy dips, sell rips to the 5,400 area, and buy pullbacks to the 5,300, looking for the 5,400 area. That is the play for the week. Now, guys, just off the cuff, Nvidia stock officially split today. It trades at $120 per share. Just a real quick 10-for-1 stock split. No biggie at all. And just to give you guys some data here, stocks that split tend to outperform the S&P 500. We can actually see here that if we look at the all-time metrics, the S&P 500 has actually returned 11.9% in total return. Stocks that split have generally returned 25.4% in the 12 months after their split. This is not just the case in all time. This is the case if we look at the last 10 years, 2000 to 2009, 1990 to 1999, and 1980 to 1999. Stocks in general, that split outperformed the S&P 500, and that's probably going to be the case. We probably will see Nvidia outperform the S&P 500 from now until the end of the year, because the stock is on absolute fire, and it is the market leader in what is the biggest secular trend since the dawn of the internet. Now, looking at sentiment, guys, BOFA's bull bear indicator continues to move ever so slightly to the right and towards the sell or extreme bullish side right here. This obviously means that stocks are going up. This is a bullish sign. If it were going the other way, that would be a bearish sign, and this would make stocks more attractive. And what this indicator, which is more of a medium to long-term indicator, is telling us that we want to hold the equities we have right now. And the same sentiment is being reverberated here from Goldman Sachs sentiment indicator. Not really much has changed from last week, except we did see this go to 5.9 from 5.5. So we are drifting ever more towards the sell side here, and we are staying in the stretch positioning. So if you guys are long equities, you want to be holders of that. I think once this gets to the 6.5, that's when we can really start looking at maybe trimming our positions. But for now, you want to be holders of equities and you want to have conviction. That is what these two indicators are telling us. Now, we don't have a massive week of earnings. We've got three real big names. We have Oracle here Tuesday after the bell, then Broadcom at the same time after the bell, and then after the close on Thursday, we have Adobe. That's really it. There's a couple of other names like Casey's, Rubrik, VistaGen on Tuesday, but really the big three names all report after the close Tuesday, Wednesday, Thursday. And these three stocks can bring a lot of volatility here in software, semiconductors, and infrastructure tech, as well as the cloud side. So if you are invested in those names, be prepared for volatility, but also be prepared for upside momentum. Adobe has been beaten down quite a lot this year, and we're definitely looking for some form of a turnaround, maybe some bullish signs. But I'll keep you guys updated on every single one of those. So go ahead, subscribe to me below so you don't miss earnings, because we cover earnings every single day on this channel. Now let's actually talk about earnings as a whole. S&P 500 blended earnings, pretty much near the end of earnings season. Right now we're sitting at 8% earnings growth on 3.8% growth year in revenue. The expectation was 3.5% at the start of earnings season. And if you exclude energy, we're looking at 3.5% in revenue, 11.1% in earnings. So very, very good earnings season. Now with earnings coming in really good, where does that leave us with valuation? Now the S&P 500 trades at a hefty 20.9 times earnings, a bit pricey, 1.2 times PEG, 3.3% free cash flow, 3.2x EV to sales, EV to EBITDA 15 times. So yeah, looking really pricey on all metrics, but not every sector is as such. Energy and financials actually look quite attractive on a PE basis, trading at 11.8 and 15 times. But if you actually go down and look at the most expensive sectors on a PE basis, it's consumer discretionary and information technology. They actually look far more attractive on a PEG basis. So let's just compare the pair, right? Tech trades at 28.8 times against discretionary 23.9. Consumer discretionary's PEG is 1.3 against technology's 1.4, and consumer discretionary trades at a much greater free cash flow yield of 3.3 against tech's 2.5%. So definitely more value to be had here. More growth is actually expected in this sector right here, and more free cash flow to deliver to shareholders, roughly speaking. But this only looks 12 months out, and when you actually look further than 12 months, the growth in tech is actually quite superb, and that's part of the reason why it's the most expensive sector here in the S&P 500. But if you're looking for growth, look at tech, look at consumer discretionary. If you're looking for value, look at energy, look at financials, look at real estate. If you're looking for growth at a reasonable price, look at comm services, look at healthcare. Now, let's actually talk about the rest of the week. Now, we have FOMC here on the 12th of June. The expectation is to leave the interest rate policy as it is, but what's more important is actually the dots. We're getting economic projections from the Fed, and that's really going to determine what's going to happen in the market. The FOMC is not so much important. It's the economic projections that come from that. We also have two other major data points, CPI, PPI. Now, the expectation for that, the headline figures is for the year over year to come in at 3.4% and the month over month to come in at 0.1%. And then the core variance of that, the year over year figure to come in at 3.5%, and ex-food and energy, the core version, to come in at 0.3%. We also have PPI on the 13th, a dense week of data, headline 0.1%, ex-food energy 0.3%, and then BOFA's estimate here of the ex-food energy and trade, which I believe is super core, comes in at 0.3%. So a heavy week of data. And the second we have a heavy week of data, we tend to get subpar returns. You can actually see that no news is actually good news, because uneventful macro weeks are the best weeks for stocks. Normally when we have 0 key macro data releases, we return 0.62%. But when we have 3 like we do this week, FOMC, CPI, PPI, we actually have returns of about 0.2%. So still positive, but do expect volatility this week. That is one thing you must expect, especially with the economic projections. If the Fed come out dovish or hawkish, we could definitely see some whipsawing action from bullish to bearish, especially if we go in and out of negative and positive gamma. So do be prepared for volatility. If you are a day trader, this is your week. If you are a long-term investor, don't look at your portfolio, especially if you hold rate sensitive and cyclical names. But that is simply the price we pay for volatility, because you can actually see that about 7 times per year we get a 3% dip, a 5% mild correction occurs about 3 times in a year, and we actually do get a 10% correction about 1.1 times every single year, and then a severe correction 15% or more happens about once every 2 years, or 0.5 times every single year. And volatility is the price, is the toll we play to invest in the stock market. And in weeks like these, it's best to have a strong stomach and just stomach the volatility and actually buy on dips if things do start to look attractive. Now let's talk a bit about the economy. I'm going to talk about wages, income growth, because we got the NFP data last week. So one thing that we can say is that the employment market, the labor market is pretty hot, running red hot. However, wage growth, income growth is strong, but not red hot. And that's a really, really good thing. You can see private payroll employment, average weekly hours, average hourly earnings, all right here, currently running at 6%. The pre-pandemic average is 4.5%, but we have seen massive disinflation since the 2021 peak. And while wages are disinflating, they're not increasing against inflation. You can see here that employee compensation as well as disposable income is actually running ahead of PCE inflation, this yellow line right here, indicating that wages are disinflating. Wage inflation is not going to spiral out of control like we thought it was at this point right here, but it is beating inflation, and consumers are gaining pricing power as a result. People have jobs, but incomes aren't running as hot as you would think they are. Now, I got this comment right here saying, please comment on the household employment survey showing a decline of 408,000 jobs here in May. And in the most recent NFP report, and there was a lot of talk about jobs and part-time jobs, but what they totally don't tell you is that part-time jobs for economic reasons is only 2.5% of the labor market, which is historically low. Most of the part-time jobs are for non-economic reasons, suggesting a strong labor market overall. At the same time, layoffs, lowest since December 2022, actually decelerating from the highs in Jan 2023. So a lot less people are getting laid off, and this just points to a strong labor market. And also the quits rate is actually back to the pre-COVID levels. A lot of people will be talking about the quits rate saying it's falling, and this is often a sign of a weak labor market, but the truth is we're just back to the pre-COVID levels here at 2.2%. And when you look at the data in totality, wage inflation is decelerating. There's not going to be a wage price spiral like we were all worried about 6 months ago. Stuff like layoffs and the quits rates are simply normalizing back to pre-COVID levels. At the same time, employee income and employee compensation is outpacing the rate of inflation. And all of this points to a healthy, robust, and normalizing labor market. And if you're trying to look for weakness in the economy, it's really bad to look at data points like these, because they can often be skewed by COVID, pandemics, interest rate policy. If you really want to look at a barometer for the economy, you really need to look at something like credit spreads. This is the yield spread between BAA corporate bonds and US Treasury bonds. And if the credit markets aren't worried, as you can see, credit spreads are at record lows going back even before COVID. Look at 2017, 2018. If the credit markets aren't worried, it's hard to see a major economic slowdown headed our way. And until we actually see yield spreads shoot up very quickly, or yield spreads expand in a very material way, it's just going to be business as usual. Which means take your cash and buy assets. Buy cash with your cash, invest, and let time and compounding do its thing. Now, what assets should you buy? Now, this is the undervalued portfolio, and this was actually a portfolio I gave to you guys here on the 21st of September. I put it out on Twitter, and it's a portfolio that I've remained convicted on. I've actually gone ahead and only done one update. We update this portfolio every single quarter. As you can see right here, if we just zoom out a little bit, we've only made one adjustment in the first quarter. These are the current holdings in the portfolio, and I'm pretty transparent with it. It's equally weighted. We don't do any rebalancing. We just keep them as they are, let it compound throughout the year. And this is the result of the portfolio. Now, if you're on my live streams, we go over this portfolio quite a bit, you know about it. But for those of you that don't, the undervalued portfolio is up 24.06% against against the 12.7% of the S&P 500 right here. It's outperformed the Nasdaq. It's actually outperformed the Japanese market and a bunch of other markets as well. But this is the investments in the portfolio. Now, they're not all profitable. You could see that Accenture was what we let go. There's zero in here. The worst performing stock is actually Fortinet, down 11%, followed by Cisco, Salesforce. So some of these software names, F5 definitely getting hit the most. We do know that software has been a bit of a dumpster fire here in 2024, especially in this last 6 to 8 weeks. But you know, the portfolio has some big winners: ASML, American Express, Alibaba is finally positive for the year. It was actually down significantly. We do have Nvidia in the portfolio as well. Google there too. PayPal up 9.5% for the year in this portfolio, doing really, really good. And Charles Schwab. This portfolio is predominantly tech stocks and financial stocks, with a focus on finding high quality businesses and growing revenues 10% plus, growing earnings 15% plus, and acquiring those companies at a reasonable price. A lot of these companies that may seem overvalued right now weren't overvalued at the start of the year. I bought ASML when it was at 23 times earnings. I put Nvidia into this portfolio when it was at 21 times forward earnings. And this portfolio is really just for long-term capital appreciation in high quality businesses with a high return on invested capital. This is what this portfolio is all about. Now, the other portfolio I gave you at the start of the year was the top picks portfolio. Now, the top picks portfolio is more of a growth orientated portfolio. It's very concentrated. There's only 5 positions compared to the 11 in the undervalued portfolio. The undervalued portfolio is more of a growth at a reasonable price. The top picks portfolio is growth at all costs. These are the 5 positions right here. There's been no additions or deletions in this portfolio. I gave it to you guys on the 2nd of January. By the way, this is Australian time. It would have been the 1st of January in America. Now, the performance of this portfolio on a year-to-date basis is actually kind of crazy, up 54.67%. Very, very strong performance. And again, look at it against the S&P 500, 54% against the 12% of the S&P 500, 16% of the Nasdaq. We could actually add these, I believe, onto it. Yeah, we can. Look at the performance against the S&P 500 and the Nasdaq. Look at the Hang Seng. Look at the performance against the Japanese index. The top picks portfolio has completely outperformed every single one of these indices. It's been a fantastic portfolio, but it's super risky, a highly concentrated names. And if, you know, at any point this portfolio can lose and be insanely volatile. I mean, look at this peak to trough drawdown right here. From March 23rd all the way into May, it was down 15%. So you do have to stomach quite a bit of volatility, but you can see every single stock in this portfolio is up significantly, with the worst performing stock being AMD, up 21% for the year. And you don't scoff at a 21% gain right there. The best performing stock is actually Nvidia, up 144%, then CrowdStrike, Alphabet, Celsius, and Advanced Micro Devices. Now, a lot of these stocks are down big. Stuff like Celsius and AMD are down like 30% from their peak. On a peak to trough basis, at one point this portfolio was actually up 58%. So very, very crazy gains, are all things considered. If you don't know what stocks to invest in, you can look at these 2 portfolios. The top picks, they're just on my Twitter, as well as the undervalued portfolio. This is growth at a reasonable price, and this is just a growth, hyper growth portfolio. Pick your poison and then go from there. Now, guys, let's look at seasonality. This right here is the S&P 500 4-year cycle. Now, essentially, they just include every presidential 4th year as well as every year ending in 4. And this is the returns we can expect for 2024. And this is where we are right now. You can actually see what normally happens in a year like this is that we normally actually trend sideways for quite a bit. We then actually experience a bit of weakness and pull back. You can actually see that we pulled back all the way here in the April into the May period, formed a bottom here in the May period, and now into June we're actually rallying all the way up. And what we can actually expect into the June, July, August, September period is actually higher highs, higher lows, and quite a sharp rally into the September period, into the October period, where we do find seasonal weakness around that time of year. So if we do get higher price action, that is seasonally expected, at least according to this cycle right here from Ned Davis Research, and seasonality is on the side of the bulls. Now let's quickly dive into gamma. Very, very weird situation happening here with the gamma tape. Now 5400 continues to be our put support, but the big change comes here at the gamma flip. The HVL is now at 5300 and the put support is now at 5100. So the gamma flip moved up, the put support support actually moved down. This is where we're sitting right now. Now, the 5200 is still a pretty big elevated strike, but this goes to show the positioning here into FOMC. So don't consider it out of the realm of possibility for us to possibly sell to the 5100 area. We could slice right through the 5300 area. I mean, we could find probably good support here at the 5200, slice right through it, especially if the data goes against the way of the bulls. So expect volatility for the rest of this week, especially with bond auctions, FOMC, CPI, PPI, projections, interest rate projections. But as long as we are in positive gamma, you want to buy dips, sell rips to the 5400 area. We are in positive gamma right now, but that could change at any minute, especially with some of the macro events we have this week. But looking at liquidity conditions, it is still overall supportive for equities. We can see here that both for the United States and the Eurozone, liquidity conditions are above the zero bid zone. In other words, it is supportive for equities. And in an environment like this, short term, long term, medium term, you want to be buyers of stock because liquidity conditions are on your side. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.